Bruno, tell me about negative amortization loans.
When most people take out a loan for a home, part of what they pay back goes towards interest. Granted, in the first several years of the mortgage, there is considerably more going towards the interest, but eventually the amounts evens out. By the end of the loan, once the interest is almost entirely paid off, the majority of the payment goes straight to the principal, actual amount owed for the home itself. However, in a handful of states, California being one of them, a homeowner might be paying over $1,000 every month on their mortgage, but the amount they actually owe the lender is still going up. These mortgages are called negative amortization loans. They're only offered as adjustable rate mortgages, also called as ARMs. They offer a low starting interest rate, a teaser to get you drawn in. The initial rate is usually a percentage point or two below the current offer rate for a traditional fixed rate loan. The lender will put a monthly payment cap on the mortgage, but not one on the interest rate. Or alternatively, there will be a cap on the interest rate, but it will be high. For the first year or two, or even for the first several years, mortgage payments are paying off the principal as well as the interest due. Then your interest rate goes up, but not your payment amount, thanks to the lender locking in a monthly price for you. You may still be paying off some of your principal, but not as much as before. As interest rates go even higher, soon you will be paying only interest. And then after another increase, only part of the interest.
Bruno, what amount of money goes toward the principal?
Let's say your original loan amount was for $200,000. Your loan payments were capped at $750 a month thanks to a loan interest rate. Initially, $500 of that was going to interest, then $400, $300, and so on. Now the entire $750 is paying for the interest on your loan, but there is another $100 in interest every month that you are not paying for. That amount is being tacked onto the amount that you owe. So even though you are making your full payments, your principal is going up. As the principal goes up, the amount of interest you're being charged also goes up. 8% on $175,000 is much less than 8% on $200,000. Your loan goes up every month, even if your payments haven't, and each month you get more and more behind. Negative amortization loans are not legal in most states. Unfortunately, as I stated earlier, they're still legal in California. In fact, if you compare the states that allow negative amortization loans with the states that have the highest number of foreclosures, you'll see a lot of the same states on both lists. Potential home buyers with poor credits are usually offered a negative amortization loan before they qualify for anything else. Unfortunately, accepting one of these loans and later losing it to a foreclosure or a short sale can further damage your credit.
So Bruno, negative amortization loans are not recommended?
If at all possible, avoid negative amortization loans. If you're getting an ARM, be sure to ask your lender if the loan is negative amortization loan. And if your loan has monthly interest rate adjustments as opposed to every 6 or 12 months, ask again. It is more than likely only a matter of time until these loans are no longer available in the few remaining states that still allow them. Until then, do whatever you can to protect yourself from a loan that will end up keeping you in a home that you cannot afford.